So we'll start with CAPM. We'll talk about CAPM. Again, it's not something I expect you guys to be, or expect to be new for you all. I hope this is an old hat at this point. But we'll look at the formula, right? The expected return under the capital asset pricing model, we say that the expected return is equal to the risk-free rate plus the beta of the asset multiplied by the expected market risk premium, which is the expected return on the market minus the risk-free rate. Okay. And so the logic behind the capital asset pricing model says that there has to be some asset, something that has zero risk, and that thing still would provide a small return. In other words, if I buy an asset that has no risk of me losing my money, or if I make an investment that has zero risk of me losing my money, I still am going to demand some small return that comes purely from the time value of money. In other words, if I loan the US government $100 for 6 months, I can be almost certain that I will get my $100 back. There's zero chance of default, no risk in that loan. But because I don't have access to my $100 for 6 months, I'm going to charge the US government a small fee. That's the risk-free rate. Okay. Now, given that we can establish that there's some risk-free asset and that that asset has a risk-free rate based on the time value of money, any other asset that isn't risk-free is going to have some premium in their expected return that's based on the level of risk that they have above what the risk-free rate is. Okay, so if I find some savings account that has a little more risk, right? I have a Chase savings account. Chase is a huge bank. The savings account at Chase probably still has very low risk, but it has more risk than none. And so Chase is going to pay me a small interest rate fee to justify that risk. And we just walk our way up. Anything that has a little more risk should have a little bit higher return, and so it should have a little larger premium. What we're trying to do is use this idea to estimate the risk of the company, and then use that estimate of risk to estimate the expected return for the company. So to calculate CAPM, we need to do a few things. Right? First, we need to establish what the risk-free rate is. And this is observable. It's not something we have to calculate. For the risk-free rate in a US-based company, we're going to use a 10 to 30 year US Treasury bond, which is a bond issued by the US government. US Treasury bonds are considered to be very low risk. The risk-free rate is typically associated with, say, the T-bill rate, which is an even shorter duration bond. Usually the T-bill is 3 to 6 months. So depending on what you're using the analysis for, in our model, we want something with a little longer duration, so we're going to use a 10 to 30 year bond. So we just go and observe that. We just go and find the risk, the current rate of return, the current interest rate on US Treasury bills. Then we need to estimate the market risk premium, but what that really means is we need the expected return on the market, because the market risk premium is the expected return on the market minus the risk-free rate. And then we have to estimate beta. Now this is the hard part. We can observe the return on the market. We're going to use a historical return on the market. We can observe the risk-free rate. We're going to use the current rate being paid by US government on their bonds. We can't observe beta. Beta is an estimate based on the relationship between the expected return on the market and the actual return on the market and the actual return on the stock. Right? So if we're talking about UPS, beta is the estimate of this relationship, how these two things change together. Okay? So we'll start with the risk-free rate. Again, this is observable. So the important thing here is that the cost of capital has to be in the same currency as the company's reported financial statements. So that just means that for a US company, you need to use US risk-free rates, US Treasury bonds. If you're looking at a German company, then you're using a German Euro bond, what they call a bild. If you're looking at a Brazilian company, then you're using Brazilian government debt. Japanese company, Japanese government debt. You get the idea, right? So we need to identify the risk-free rate, and again, some of these countries may not really have a truly risk-free rate. For instance, Brazil or a lot of the South American countries like Argentina have defaulted on their debt in several important ways, or they at least have a very high risk of defaulting on their debt relative to the US. And so it's hard to say that using a, say, 20-year Brazilian bond is truly risk-free in the same way that using a 20-year US government bond is risk-free. And even that isn't actually true, right? 20 years is a long time. We don't know that a 20-year US government bond is risk-free. It's closer to risk-free than a Brazilian bond, though. So it gets a little murky when we're talking about developing countries and countries that don't have established financial systems as the US. So either way, it's more important for us to use the correct denomination, the correct bonds, so the bonds that are related to the currency that the firm uses, than it is to worry too much about whether the bonds are actually risk-free. Likewise, it's more important for us to use a longer duration bond, so we shouldn't be using anything less than 10 years, because we want that to match up with our projected cash flows, which are going to be 10 to 15 years out into the future. So I'm discounting those cash flows 10 to 15 years out in the future. I want to make sure that the discount rate I'm using also has a duration that is 10 to 15 years in forward looking. Right? So that's going to be more important for us than any than too much concern about whether this is truly risk-free or not. Because especially for US companies, we consider even long-term bonds to be close to risk-free. So the next thing we need to do is estimate the market risk premium. And the market risk premium is the expected return on the market minus the risk-free rate. So really, because we've already observed the risk-free rate, all we need to do is observe the expected return on the market, which is the average return for all stocks on the market. Now, this is still something we have to estimate, but it is something that we can do a much better job of at the aggregate level than we can do at the individual level. Okay? In practice, what most people are going to do is use the expected return of a broad market index, like the S&P 500, although personally I think that's still too small. You can easily statistically calculate the average return for the entire stock market using statistical software. And so that's my preference when I have to do this kind of thing. Just take the average market return and use that, right, as my expected market return. Because remember, my best prediction about the future comes from the past. Okay? Now, in previous years when things aren't as crazy and I have more time, we can get into some more sort of philosophical and academic discussion about the market risk premium, and that's because the market risk premium is a very studied thing in finance, and it is too large to be explained by what we know about risk. Right? In other words, none of the models that we have can currently correctly explain the size of the market risk premium. And all that means is that the average expected return on the market is too large relative to the risk-free rate for our models to predict. And so we do have some issue with estimating the market risk premium, or maybe not estimating, but explaining the market risk premium. And so that's not something I really want to get into in this type of lecture. We've condensed the class, we've lost a couple of weeks time-wise, so I'm going to jump through a couple of these next slides that are more about the academic distinctions and less about the practical importance of estimating the market risk premium, because practically everyone is just going to use the historical return method. So we're going to look at the historical returns of the stock market and then use that as our expected return on the stock market going forward. Okay. And so here's what that looks like. Right? Over the past 82 years, the S&P 500, again, this is a relatively broad market index, but there are other larger indexes. There's the Morgan Stanley Capital Index that I think has like 1,500 stocks in it. There's a Russell 2000 index, and then again, personally, you can just take the average return for across every stock in the stock market, because computers can do that really easily. But if we just take the S&P 500 here, over the last 100 years or so, the S&P 500 has earned on average 11.1% as an annual rate, right? So these are the largest. S&P 500 is the largest 500 stocks in the U.S. market. So these are the biggest companies, and on average they provide an 11.1% return. Now you can see in this graph here that smaller companies actually provide historically a larger return than larger companies, and that's a distinction we're going to talk about again later. And that's why I like to use the average return for all companies, but that is also sort of up for discussion. Then we can see corporate debt has an average return of like 5.8%, government bonds of 5.9%, Treasury bills, these are short-term government bonds, so long-term government bonds have higher rates. Short-term T-bills have much lower rates, inflation about 3% over the last 100 years. Right? What that means is that the market risk premium historically has been about 5.2% based on the S&P 500, but on average for the whole market it's been about 8%. Right? So that means on average for the whole market the stocks are returning 8% more than bonds. Right? And this 8%, that's what I'm talking about when I say we don't have good models to explain why that figure is so large. Right? We know stocks are more risky. We know they should have higher expected returns than bonds, than risk-free debt. We don't really have a good explanation for how all that risk gets developed. What are all the risks that are being compensated for in that market risk premium? So we're using the historical rate here. So we would just look at the average market return for the year, and we would go forward there. Again, I'm going to skip these next two, talking about long-dated holding periods and talking about the embedded market risk premium. This is a more academic type discussion, and it's just not important right now. I'd rather have you get through the practical material, especially when we are condensing so much of this into a smaller package.